Hello, Steve Lentz here with Discover Options, and welcome to this edition of the Market Reports. This is for Friday ending September 23rd, getting ready for Monday, September 26th. Today we have two reports for you, the S&P 500 Condor Butterfly Timing Report and the Directional Likelihood Report as well. Here's the Butterfly Timing Report. It shows a positive edge. We're going to get right to it. And then also the Market Likelihood Report, and we'll explain how this is interpreted as well. Before we do that, want to make sure you know that you can go to our website and get our free e-trading book. You can also click on the link above. And also, if you want to subscribe to this broadcast at this channel, you can click on the button below. Love for you to do that. We love having you aboard and taking a look at this quality information that's unique to Discover Options. The Butterfly Timing Report is unique. It's very important. It's important that you take a look at it, and we're going to explain the methodology. Then we're going to get right into the actual report and the current condition. If you had back in December 31st, the market began to channel around a little bit, and you might have thought this was a good time to do a butterfly or a condor in the SPX. Well, our algorithms showed that indeed at the time there was actually a negative edge to doing that, and indeed the market did go down quite a bit. At the time there was a higher than usual likelihood that the market would be more volatile than what was being implied by option prices. Indeed, the market did go down. Now, that's a cherry-picked example, granted, but nevertheless, at the time, it's interesting that there was a negative edge going into that, even though you had what appeared to be a channeling market that might have been very attractive. So here's how we do this. We take the current condition of the market, and right now, the market is above the 75-period simple moving average. We have an up day on Thursday, an upswing day, then Friday was a downswing day, yet the stochastics are trending upward. Okay, the 15-3 is between 40 and 90, and it's above its 3-day moving average, so that's bullish. This is a unique condition that's occurred only about 65 times since January of 2000, believe it or not. So here's the question. Is this current condition a good one for selling option premium through range trading, butterflies, condors, etc.? Well, to answer that question, here's what we do. We look at the actual market volatility in the market. We look at the implied volatility, and then we're going to compare those two and deem bars either favorable or not favorable for selling premium. So let's take a look at the actual volatility. You could take a given close, and we define the actual move going forward as being the farthest move that the market made over the next 21 days, whether it's up or down. In this case, you could see that the market did go down a bit there, and it turns out that that was a move of 2.4% on the downside. Now, at the time, here's the question. At the time, what were the options implying? What were the option prices implying that the move would be in the future? We know what the actual was. What was the implied? And at the time, the implied the implied move was 4.4%. Now that's a bit higher than what actually took place. So in retrospect, that bar at the time was turned out to have been a favorable one for selling premium, because the options, they were implying a move greater than what actually came about. And so we would deem that favorable, and what we would do is paint the bar blue and label those blue bars favorable for selling premium, and the red bars turned out to be bars that were unfavorable for selling premium, meaning that and you could see the red line there, the actual move was higher than what was being implied. Okay, so you have favorable bars and unfavorable bars, and we're all moving towards an understanding of what our edge is right now, given our current market condition. That's what we're looking for. So here's how we do this. Historically, we ask ourselves what percentage of the bars were favorable. Okay, what percentage going back to Jan of 2000 in the SPX, how many of those, what percentage were favorable? Then we look at the bars that match our current market condition, those 65 or so. What percentage of those were favorable? And if there's a difference, there could be a negative edge or a positive edge. So when we look at the baseline number going back about 4,200 bars or so, you have about 64.9% of those are favorable for, in retrospect, for being able to sell premium neutrally, butterflies, condors. Now when we go and look at the market condition we have now, and I put a little diamond next to those that it worked out. Of those bars that match our current condition now, what percentage of those were favorable? Turns out 72.3 were favorable. Now that's higher than the baseline of 64.9, so that's where that 7.4% edge comes from. So right now, and here's the conclusion of the report, there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So that's the butterfly timing report for you. Right now, as of Friday, we have an edge. Let's go to the market likelihood report now, but before that, I want to make sure you understand that at Discover Options, we have a full array of options mentoring services. We can get you from a beginner to an intermediate and advanced level very quickly in as fast as time as possible through our very progressive and programmed curriculum that we have here. We have professional option traders that that would mentor you, hold your hand one-on-one to get you through the process and help you with your homework and answer all your questions and kind of take our money management models and compare them to what you're doing. And we're not an advisor. We're not a registered advisor, but we can certainly educate you as to what to do. So there you have it, and we'd like to hear from you, and we can customize a curriculum for you as well. Okay, let's take a look at the market likelihood report. And what this does is it answers the question, since Jan of 2000, how often has this same condition occurred, market condition that I just showed you, and what did the market what did the market do in terms of direction and volatility? What did it do? Well, here's what we do. We're going to look at the historical distribution of price to answer this question. We're going to do three things. We look at the historical distribution of price. We look at price distribution after our particular market condition developed. And then we try and ascertain if there's an edge that exists when the two are significantly different, when the distributions are different. So how do we determine the distribution of price? Here's what, what you could do is just say, when our, from any given close in 5, 10, and 15 days, was the market, how much was it higher or lower? Okay, from a given day to a given day, from a close to a close. And that really does not tell you the distribution of price. So here's what we do. We measure price, we measure the distribution by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price. So there's three sets of these: upper and lower 5, 10, and 15-day bands. These are measured one standard deviation from the close. Okay, they use a 20-day historical volatility level, and they're log normally distributed. So here's an example. You have a given close here. You have 10-day bands posted above and below the close. Now the question on the table is the market going to hit the upper band, the lower band, or wobble in the middle? What did the market do? So when we look forward in the future, we can see that the market went up and hit the upper band. So in our database, in our statistical database, we record that from that particular close, it ended up hitting the upper band. Now let's look at the close on the right side up here. You see that one? Okay, and you see the upper 10 and the lower 10-day band. What did the market do? Okay, let's go forward, and you'll see that the market wobbled in the middle. It did not go down and quite hit that lower band there. It came close, but no cigar. So in our database of distribution points, we say that from that close, it hit neither the upper or the lower 10-day band. So here's how we do this. From every close, we record how often price struck the upper and lower 5, 10, and 15-day bands to get our distribution. And here's how it worked out in distribution from Jan of 2000 to September 23rd. Okay, in the SPX, price struck the upper 5-day band 29% of the time, struck the upper 10-day band 23% of the time, the upper 15 about 23%. It struck the lower 5 about 30% of the time, the lower 10 30, and the lower 15-day band 32.5% of the time. So that is our benchmark distribution. Now let me ask you, after a certain market condition, let's say it's the perfect setup that you believe in. Okay, maybe it's a moving average crossover. some kind of technical price event that you're excited about. If you were to run this through and look at the distribution after your event has occurred in the past, and you discover that it hits the upper 5, 10, and 15-day bands 100% of the time, and hits the lower 5, 10, and 15-day bands 0% of the time, you would conclude that that's an extremely bullish and potentially an extremely successful technical setup, right? Well, and this is kind of a tool to try and find that kind of holy grail. All right, and a lot of times what you find out is that you take a certain technical condition, you run it through the algorithms here, and you know what? It's actually, it doesn't even meet these benchmark levels. It'd be better to flip a coin, all right, than go with a technical setup where there's no edge at all. So what we're going to do then is take our market condition and see what the distribution point is after it. Okay, we're going to understand the distribution after our market condition, the one we have now, develops. So here you have it. Now we're going to look at the distribution not only at the close, but also if price goes above Friday's high, and also if price goes below Friday's low. So that way you kind of have a good trading plan going on and some expectations of distribution whether market goes above Friday's high or low. So there you have it. I think you should have a good little edge then in the market. So here's how it worked out. As of the close on Friday, that same technical condition that's occurred 67 times in the past. Of those 67 times, it hit the upper 5-day band a little bit less than the benchmark. It hit the upper 10-day band about the same. It hit the upper 15-day band about the same. Okay, no real edge going on here. Okay, it hit the lower 5-day band just a squeege more often, slightly bearish, just very little. Lower 10-day band a little bit less, and it hit the lower 15-day band less. So a little bit of a mixed picture here, unfortunately. We're not seeing something definitive come about. Now let's go and see what happened if the market went above the high. If it goes above the high on Friday, if it goes above Friday's high, we can see that on the 5-day it's about a wash. 10-day band, look at that, it definitely hit the upper 10-day band more often. It also hit the upper 15-day, just about, that's pretty much the same. It hit the lower bands definitely less often than the benchmark there, okay? So we can see that if it goes above Friday's high, definitely lean a squeege bullish in terms of the distribution. Is it enough to get excited about? Probably not. We're seeing, sometimes I've shown you stuff here where it's definitely showing you a bullish or bearish bias. This is kind of a wash, not really huge. Now, if it goes below the low on Friday, okay, then it hits the upper 5-day band quite a bit less often, 13% less often in fact. Hits the upper 10-day band 3.6% less often, and the upper 15-day band less often, more or less even less off, 19 compared to 22. It hits the lower band more often on the 5 and 10. And so we can see that if it goes below Friday's low, now we're looking at a bit of a bearish bias. So that's something to hang your hat on here. If there's anything to hang your hat on the distribution, it's going to be that if it goes below Friday's low, you have a distribution pattern in the past that looks bearish from that point, okay? So there's that. Now, one thing I like to do is recast these volatility bands using the VIX, the skew adjusted VIX, so that the upside has a little bit lower volatility going into those bands than the downside. Recasting those bands, same kind of picture pretty well. Okay, at the close we see a picture of lower volatility, kind of a wash, but slightly leaning to the lower volatility level where it's hitting the bands less often. If it goes above the high, 5 of the 6 are experiencing less volatility. And if it goes below the low, again, we're seeing a bearish bias where the upper bands get hit less often and the lower bands get hit slightly more often. But again, slightly is the key here. Here are the volatility levels. Statistical volatility in the last 20 days is at 10.9. The downside volatility has dropped now. It was way up above 17. Now it's at 13.8. We're going to take that number and give you a trading idea. Hedged bull put spread, especially if the market continues up above Friday's high. Okay, if it goes below Friday's low, maybe kind of back off this kind of an idea. But here's the notion here on a hedged bull put spread. We take that 13.8. We plug it into the SV box in option view. We set up a bull put spread here, a 5-lot 20-point spread, a standard deviation away. And we do a little 1-lot bear put spread to provide some hedge on that. Make sure that there's enough for a net credit coming in, as there certainly should be in this situation. When you analyze it, you have just a wonderful coverage of prices, where if price goes up at all, you're going to make money, upwards of 9% at expiration. If it goes down, that hedge kicks in and begins lifting that left shoulder up, so that even at expiration, if it goes down less than the standard deviation, you're going to make well more than twice what you're trying to make if it went up. If it goes down and hits that short strike, it looks like you could lose about the same amount as you're trying to make at expiration if it just stayed above that 1 standard deviation level. So it's a real nice coverage, and when you look at the price chart profit area, it's nice and green through a wide range there. Okay? Folks, thanks for joining us. I'm Steve Lentz with Discover Options. We'd love to hear from you. Tune in next week. Same bad time, same bad channel. Take care. Bye-bye.